Hey dividend investors, today I'm going to talk to you about my top 3 picks for dividend stocks next month or this month in February. Anyways, let's get down and let's check these out. So I personally really like the banks, and this is no exception. Goldman Sachs is a fantastic company to own. They have been doing great for a long time. Their dividend isn't massive, but it is substantial. It's 1.7%, which is better than interest and is pretty good in my opinion. And from there, what we are looking at also is the average volume, and at 3.1 million shares per day being traded, I think this is a great pick to be able to get in and out of very easily. Has a good dividend in my opinion, not great but good. And also, the other great thing about this is it was one of the banks that actually had a fantastic earnings call recently. So, with the whole massive amount of more investors coming onto the scene when it comes to Robinhood traders and things like that, Goldman Sachs is going to be really doing well because of it. Now, when you look at their 5-year chart, it's kind of curious. It's kind of interesting. So, of course, they were down in that $150 range, which really does make me wonder because that seems to be a very strong level of support, roughly in that 150 range. From there, over 5 years, it has bounced up to $250 and passed it, if not right at it, multiple times. And just recently, it has ballooned past and up to the $300 range and a slight pullback lately back down to $283. So considering that this was the range of trading for so long and it's finally broken past, I think that this has got time to grow, time to run, and with the impressive amount of traders that are now hitting the market, I think that they are going to be benefiting hugely. And then when you start looking at the earnings, they, of course, through those 2 quarters didn't do very well. Of course, that was the coronavirus that was starting to really hit the world. And now we've had 2 quarters in a row of good earnings, actually massive beats on the earnings. We have also seen a very nice improvement of revenue as well as roughly level earnings, but at least the revenue is going that way. When it comes to massive companies like Goldman Sachs, we have to remember they may be growing revenue, they may not be growing their earnings, but they are growing their revenue, which means to me, like Amazon, where when they finally decide, hey, we're going to cut off the nozzle and we're going to be creating more earnings from our revenue, that earnings number can shoot up huge. Massive. When they decide to say, yep, we are no longer spending money and we are just collecting it, and no longer spending it out on staff and things like that, especially with more and more computers coming into the scene for banking, yeah, that is going to be a massive turnaround when it comes to revenue. I think that has room to grow on the earnings side. The next one is another bank, and this one is CIBC. Of course, this is the Canadian version of it, but you can also get this on the American market as well. It currently has a 5.26% dividend at the time of making this video, and they tend to grow that dividend quite often. Usually with CIBC, it's twice a year recently, but of course coronavirus has kind of changed that, but I would not be worried about this stock. Something about Canadian banks that not many Americans know about, at least, is the fact that, yes, they have paused the growth of dividends, but they still pay their dividends. They have never lowered their dividends, the big banks anyways, not including Laurentian Bank. They're not big. Now, going from there, they have not lowered or stopped their dividend in over 100 years. CIBC, I think, is somewhere around 120 years. So even though they went past or through massive recessions, they've gone through the 2008 recession. They went through that massive recession 100 years, close to 100 years ago. Like, they know how to handle money. Canadian banks are basically a monopoly. They also have a lot of their mortgages and loans insured by the government and other insurance companies. So yeah, there's no way that you need to worry about a Canadian bank going under. At least a big one. And again, average volume is 2.2 million shares per day, which is easy to get in and out of. This is their 5-year chart, and this is what I every time I hear somebody say, oh, why would you invest into a Canadian dividend ETF? It doesn't do anything. Well, they're only looking at the last 5 years, and as you can see in this one, yeah, the Canadian stock market in general hasn't really done anything in a couple of years when it comes to oil, financials, or any of the bigger movers when it comes to the market. So as we can see, this was a huge buying opportunity, and I was buying all the way down that. I originally got in at CIBC roughly in that range, in that 2017 area, and then I've just been growing my investment ever since myself. Their earnings also haven't been all that bad. They only had 1 quarter of a miss. Unlike the Americans and American banks, who have been having 2 to 3 quarters of missed earnings, the Canadian banks, pretty much all across the big banks anyways, they have only had 1 bad quarter, and the rest have been beats when it comes to earnings. Again, the revenue is pretty well stagnated, as same as earnings. So this is not a growth story. This is just purely a let's get a little bit of maybe a 2 to 3% gain every single year on the underlying stock, and then make our 5% dividend to pay for our lives, especially if you want to be like me and not work a day job. And the next one is Enbridge, of course, oil companies. And yeah, when it comes to energy and things like that, there's a lot of different news and things that you have to really worry about. You have to worry about not just the news cycles. You don't have to worry about the president of the United States. You also have to worry about earnings. You have to worry about, can they get oil out of the oil sands in Canada, which seems to be pretty well damn near impossible. So from there, they do pay a massive dividend, 7.5%. And from there, they seem to be really set up well. They are, in my opinion, a oil and energy company. They do a lot of the shipping when it comes to the oil. And yeah, any company that can try their best to try and get oil out of the oil sands. Anyways, 9.7 million average volume. Easy company to get in and out of. And again, they have not had a great time. They are down once again. I would assume that once things start opening up, once there's more gas and oil being used once again, they will probably float back up into the 50-60 range. But again, hard to say, but I kind of like the dividend. Of course, do your own research. Never bank on somebody who you see on the internet. Random people like me can make whatever kind of videos that they feel like making. So, of course, do your own research. I hope that you've enjoyed, and I'll see you guys again next time.